The 10-year Treasury yield is on the rise, and the 3-month Treasury is about where it was at the beginning of the year. Does this mean that we could have a more normalized yield curve? And what's going on with AI stocks and technology? We're going to discuss all this and more on this month's monthly economic update. Stick around. Hello, everybody. I'm Dean Barber, Managing Director of Modern Wealth Management in Lenexa, Kansas. Welcome to the Modern Wealth Management Monthly Economic Update. It's February the 28th here, 2024. Been a good start to the year for equity markets and not such a good start for bond markets. So we're going to explore a little bit about what's going on within the markets, look at some different sectors of the markets, what's doing well, what's not doing well. We're going to take a closer look at the Treasury yield curve and what that's done so far this year. As we look at GDP for the fourth quarter of 2023, the latest numbers just came out, and the GDP growth was revised down to 3.2% from the first estimate of 3.3%. And so, while that's good news, we don't want that GDP running too hot. We don't want inflation to come back and rear its ugly head again. But let's put that in perspective. So if the GDP of the United States, that's the gross domestic product, increased by 3.2%, that's an increase in actual dollars of $333.5 billion. That's impressive until you think about what our national debt did during the fourth quarter of 2023. We actually increased our national debt in the fourth quarter of 2023 to $834 billion. So that's $2.5 in debt, in additional debt, for every $1 added to GDP. So that begs the question, is this just like a college student putting a bunch of money on credit cards that's fueling the economy? It's what it seems like is happening. I do know that there are some really strong parts of the economy, and there's some really parts that are still kind of struggling. So let's take a look here at, on a year-to-date basis, our best performers. And if we look up here at our NASDAQ composite, there's no question and no surprise that the NASDAQ is our number one performer once again. And the NASDAQ composite, as you can see here, does get the bullish rating, with 44 stocks being rated bullish, 48 being rated neutral, and only 8 being rated bearish. And if you look again here at the top 7 holdings, Microsoft, Apple, Amazon, NVIDIA, Avgo, and Meta, those are really what are driving the market. So you've got the NASDAQ up 8.7% year to date. You've got the S&P 100 up 8.39%. And it's interesting when you look at the S&P 100, what are the top stocks? Very, very similar in almost the same weightings as the NASDAQ 100. Then you pull into the S&P 500, you see the same names up at the top, just in lesser amounts. And then we want to come down here. We talked about this equal weight last time. And so the equal weight is, taking the same amount of money and dividing it up amongst all 500 stocks. And the equal weight's still up nicely on the year by 2.67%. But so because it doesn't have so much weighting in that magnificent 7, it's not going up quite as fast. But all major indices in positive territory so far this year. And as we're talking about this, we've got the markets down just a little bit today. We've got, more news coming out this week on inflation, and so we'll see where that takes us. Let's take a quick look at what's going on with the Treasury yield curve. So we've been talking about this now for quite some time, and this current negative or inverted yield curve is the longest that we have seen since the early 1980s. There's only been one time since 1955 where we have had an inverted yield curve that did not lead to a recession, and that was in 1966. Now, this yield curve's been inverted now for over a year, and you can see here the 2-month Treasury is sitting at 5.52%, the 3-month Treasury sitting at 5.45%, and when we scroll out here to the 10-year Treasury, and the 10-year Treasury is at 4.31%. So, It's come up a little bit since January. So let me just remind you here, as we started the year, the yield curve looked about the same. Our shorter bonds up here, so the 3-month was 5.4, so not a lot of significant change there. But look at the 10-year to start the year at 3.88. So the 10-year Treasury yield has come up by almost 0.5% since the beginning of the year, and that has caused the bond aggregate to lose about 2% so far this year. I do believe that the bond market today, with where interest rates set and the future outlook for potential rate cuts later in this year, do represent a nice tailwind and opportunity for investors. We're going to have to wait and see exactly how that all pans out. But to me, I can't see a scenario where we look forward 18 to 24 months and we don't have lower rates than what we have today. So that should bode well for the bond portion of your portfolio. The one thing that I would say is still be cautious of these indices that are weighted so heavily in the technology and in the AI type stocks. Those are a bit elevated in price, which ultimately means that there's some risk there, even though we're seeing very bullish signs in most of the major indices across the board. Make sure that your allocation stays intact. Make sure that you go back, and if you didn't do so, talk to your advisor about rebalancing, making sure that your portfolio's in the right position for everything that you want to accomplish. I hope this has helped, and I hope you enjoyed being with me here for the monthly economic update. Thank you, and until next time, I appreciate it. We hope you've enjoyed this video. Please like and subscribe and share with your friends.